Volatility is often treated as an external challenge, something traders must endure, exploit, or hedge against. In reality, volatility is also a diagnostic tool. It reveals whether a trading system is resilient or fragile, adaptive or rigid. In 2026, experienced traders increasingly view market volatility not as an anomaly, but as a constant. The focus is shifting away from reacting to changing conditions towards building systems that can survive them. Periods of heightened volatility tend to surface the same vulnerabilities repeatedly: unclear risk limits, inconsistent execution rules, emotional overrides of strategy, over-reliance on short-term signals. These issues rarely originate in the market itself. More often, they stem from systems that were optimized for favorable conditions but not designed for stress. Traders who survive multiple cycles learn an important lesson. Volatility does not break systems, it reveals where they were already weak. Trading discipline is often discussed as a personal trait, but in practice, it is largely system-dependent. Systems that require constant discretionary input, rapid decision-making, or frequent adjustment increase the likelihood of error under pressure. By contrast, disciplined systems are characterized by predefined risk parameters, clear execution rules, limited decision points, and repeatable processes. These features reduce cognitive load and help traders remain consistent even when market conditions deteriorate. Discipline, in this sense, is engineered, not improvised. Traditional risk management focuses on metrics such as position size, stop-loss placement, and exposure limits. Whilst essential, these elements represent only part of the picture. Long-term survival also depends on how often decisions are required, how much discretion is allowed, and how clearly outcomes can be reviewed. Systems that allow traders to reconstruct their actions objectively make it easier to identify errors and adapt without emotional distortion. This feedback loop becomes critical over extended time horizons. Markets evolve, liquidity profiles change, volatility regimes shift, and participant behavior adapts. Systems that remain static gradually lose alignment with reality. Professional traders respond by reducing unnecessary complexity, tightening execution criteria, focusing on fewer, higher quality opportunities, and prioritizing consistency over frequency. Adaptation does not always mean adding new components. Often it means removing elements that no longer serve the system. A trading system does not operate in isolation. Platform infrastructure, data presentation, and execution environments all influence how effectively discipline can be maintained. Systems designed for long-term survival require environments that present risk transparently, avoid excessive stimulation, and behave predictably under stress. Some infrastructure-focused providers, such as Finance SPR, align with this approach by emphasizing structured environments that support methodical decision-making rather than reactive behavior. The platform becomes an extension of the system, not a source of friction. Short-term performance often dominates discussions about trading success. However, professionals understand that survival precedes profitability. A system that cannot endure adverse conditions will never benefit from favorable ones. Long-term traders evaluate systems not by peak returns, but by drawdown behavior, stability across cycles, and adaptability to changing conditions. Discipline becomes the mechanism through which survival is achieved. In 2026, the most valuable trading edge is not speed, leverage, or novelty. It is the ability to operate consistently across varying conditions without abandoning structure. Markets will continue to change. Volatility will reappear in different forms. Traders who survive are those who adapt their systems deliberately, replacing reactive habits with disciplined frameworks built for longevity. From volatility to discipline, the evolution of trading systems reflects a broader truth. Success is not defined by how aggressively traders respond to markets, but by how well their systems endure them over time.